So we're going through the sources and uses of cash. For each account, compute the change from 2023 to 2024 and classify as a source or use of cash, and do the totals reconcile. So the first thing we can do is just go through each one and determine the difference. So we had an increase in cash from 2023 to 2024 of $1,894. So that's the difference here. And we can do that across each of these. So for all of our accounts, we had changes from 23 to 24, and we've identified what those changes are. Now we need to determine if it's a source or a use of cash. So when it comes to assets, when these assets go up, they're always a use of cash that it's hard to explain with cash, so we'll put this for use, but it'll make more sense with accounts receivable. If we have $23,600 of accounts receivable in 2023, and in the next year we have $25,700, that means that our accounts receivable went up and we've collected less cash. We've collected less cash from our customers. The sales doesn't matter, it's just how much money have we collected from the customers. So this is a use of cash because we now have less cash available to us and more tied up waiting for our customers to pay us. Another example would be inventory. We had 42,000, now we've got 46,000. So that means that we haven't converted this to sales and got received into sales, but we've spent more. There's more inventory on our shelves than there was in the previous year. Well, we had to buy that with something. We bought it with cash to pay for that additional inventory that we now carry. And the same is with the property, plant, and equipment. We had a $26,000 increase, and to have an increase in property, plant, and equipment, you need to have cash to spend for it. So if you have an increase in this, that means you used your cash. And that's ultimately what we're trying to do, is determine our cash flows and what affects it. Now, accounts payable, on the other hand, would be the opposite of accounts receivable. If we have 41,000, then we go to 43,000. That means we paid less bills. We've accrued more bills that we owe, and eventually will come to bite us. But for now, we save that cash. Our notes payable is the same thing. If we have 16,000, we have $700 more in what we owe. That means we received cash or some sort of benefit. We didn't pay it down. Alternatively, the $5,000, if we go from 40K to 35K of long-term debt, that means we use cash to pay that down. That's a use of cash. And finally, retained earnings at $236,000 is going to be ultimately retained earnings is what the net income flows into. So your profit, your revenue minus your expenses. So you can take that and that is a source of cash. Now, we can go ahead and see if they reconcile. So we have source of cash, and use of cash. We have three sources of cash. We have our AP, our notes payable, and our retained earnings. 35,739. 35,739. And that is a total of 39,170. And then we have our use of cash, which is these four plus our paying down our long-term debt, which is cash, AR, inventory. We've got our property, plant, and equipment, and our long-term debt. So 1894. Our accounts receivable is 2,077. Inventory is 4279. PPE is 25,920. And long-term debt is 5,000. And we end up with 39,170. So they do reconcile, and this is a sort of a precursor to statement of cash flows that we'll get into.